The meeting's kicked off this week. Big issues on the World Bank's plate. You've got record low-income debt. You've got slow vaccine rollouts. You've got economies diverging more and more. Inflation, though, now at the top of the list, it seems, everybody's list. You've been saying for months, Carmen, you think you would be not transitory, but persistent. What do you see now?
I think people have in mind also the aftermath of the global financial crisis, in which we had seen large increase in monetary stimulus in the major central banks, and no inflation issues followed. I think the point that I've been making for some time is that post-COVID is not just about the kinds of declines in aggregate demand, sharp declines in aggregate demand that we've had, after the global financial crisis, and even more forceful ones after COVID. It's about aggregate supply shocks. They're not tidily bundled like they were in the 1970s, in which you can say it's a single supply shock, OPEC, oil. But many supply shocks that are manifesting themselves in all kinds of cost pressures and in bottlenecks and shortages and the like, which make for a more persistent and stubborn inflation outlook.
Are central banks waiting too long to address this?
I'm sorry, Kathleen, I couldn't hear you.
Are central banks waiting too long to address this?
I actually, I gave the Carl Brunner lecture a couple of weeks ago, precisely looking at the issue of central banks. And my sense is central banks are in a tough position in which they don't want to derail what could be still a fairly uncertain recovery, given the cycles we've been through with the various variations and gyrations and mutants of COVID. So they're concerned about pulling back stimulus too soon. But I think the end point may be that the central banks are more likely to follow markets rather than lead them. I would point out that following markets and acting on the later side was an issue back in the 70s, even before the drama of OPEC and high oil prices. In the late 60s, inflation was drifting higher, and part of that was delayed action. And I think we're in that mold now.
Well, does it make sense? Is when you talk about, as you do so often, the very high levels of debt, up 12%, I believe, for the low-income countries during 2020, record levels now, and you make the point that that was not such a bad problem for the debt burden when interest rates stayed very low, and that most of them still are. But if central banks start responding to inflation and they start raising interest rates, does that increase the risk for these poor, highly indebted nations that they'll default, that there'll be bankruptcies, households, government, businesses?
Look, Kathleen, this is a time immemorial issue. International interest rates and their cycles have importantly impacted, for better or worse, emerging markets, throughout history. What it means now is really a two-tier effects within the emerging markets and developing countries. Many developing countries are already facing serious debt difficulties in the here and now, even if interest rates remain low. More than half of the 73 low-income countries that are eligible for the debt service suspension initiative are either in debt distress or high risk of debt distress. So that's the layer that I think would stand to be vulnerable to the to a tightening in international monetary conditions are, of course, some of the middle income emerging markets that are still have access to capital markets and are still not in that danger threshold. But
Okay.
it's definitely bad news
So
from the vantage point of an emerging market.
how about China? How about the global risks from spillover, from trying to deal with Evergrande and hit that balance between not too tough and not too easy? Is that a risk you see for the global economy?
Absolutely. Look, China played a critical role as engine of growth for emerging markets at the end of the global financial crisis. Remember, the US went into recession, Europe was in recession, and China was between 2003 and 2013, you had double-digit growth with kept commodity prices very high. This was a big boon for emerging markets and especially many commodity producers. I think apart from the risks associated with, a tighter, should central banks move to tighter financial conditions, another significant risk for emerging markets is further slowing in China. The Chinese slowdown of 2015, when China's growth rate slowed to around 6%, had a big hit on EMs. And, I think one cannot underestimate what further slowing in already an environment where there's a lot of vulnerabilities from the COVID legacy. So at the moment, I would say these are two risks on the downside to keep in mind when looking at the emerging world, which has been disproportionately hard hit by the COVID pandemic because of their wealthier counterparts.
Fed taper, Carmen, it's pretty well on the table, pretty well advertised now that the Fed Reserve seems it's going to announce that taper. Priced into markets, nothing to worry about, or is this the beginning of something that could ripple through emerging markets at a time when they are vulnerable on many levels?
Look, I think there's a group out there that's saying, are we going to have another taper tantrum? I don't think the risks that I'm talking about are risks about another round of taper tantrum. In 2013, emerging markets were, in a boom, large capital inflows, very upbeat scenario. And then the taper tantrum really was a major pivoting point and strained finances for a lot of the EMs with big current account deficits. We're not there now. I think the risks that I'm talking about are, rising interest rates, tighter financial conditions also mean potentially more hits to sovereign risk.
Okay.
Risk premium on sovereign debt goes up with interest rates by a multiple.
All right.
And I think that, especially given the post-COVID higher debt levels, is increased debt burdens, and that's a source of concern. But it's different from the taper tantrum episode.